Hello, Stuart Heath here, CEO and founder of Harvard Grace Capital, with part 9 of our series, Important Investing Terms That You Need to Know. This week we're going stuff your accountant or your advisor might talk about. And if you're a stock advisor, you still need to understand these accounting terms. So today we're going to talk about capital gain versus total return, liquidity, EBITDA, financial statements, and depreciation. I'm going to start with liquidity. An organization's liquidity is how much hard cash it can get its hands on in a fairly short period of time, sometimes thought to be 30 days. This is related to a working capital calculation, which you'll sometimes see referred to, which is current assets minus current liabilities. You might have a very, very, very valuable company, but if all of the invested capital is put in land, they're not very liquid, because it usually takes a nice long time to liquidate land. Doesn't mean it doesn't have value. It's just a measure of how liquid, how quickly you can turn assets into cash. EBITDA, what does that mean? It's actually very important. My favorite measure of operational, cash flow. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it is essentially a measure on a company's profit and loss statement of how much cash are they generating from operations. Financial statements are full with all kinds of allocations and estimations and things of that nature which will bring down earnings. And they're important, they're accurate, but if you really want to get down to brass tacks of how much cash they're generating, EBITDA is the measure you want to use. Financial statements is generally just generally refers to a package of 3 financial statements. The first is the balance sheet. A balance sheet is a snapshot in time of the financial position of any organization. The P&L, everybody understands the P&L. It's the profit and loss statement, also called the income statement, and will show you how much money an organization has made over a period of time. And then the third one, which mainly accounting geeks like me love, it's called the statement of cash flows. To me, it's closely related to EBITDA, but it also takes into account all the other non-P&L related cash items, such as debt payments and equity changes and things like that. Dividend distributions. It shows you what's really happening inside the cash of the organization. And here's one of those non-cash charges that we usually add back for EBITDA: depreciation. Depreciation is essentially referred to as cost recovery. We love it when it comes to tax purposes. We don't necessarily love it when it comes to doing our own, GAAP financial statements. But depreciation, you take the cost of an asset and you allocate that cost over 5, 10, 15, 30, even 40 years, and you take a charge against your income to allocate that. And so at the end of it, you've got this asset that now has a zero value on it. That's the historical cost method. That asset might still have real value, but for accounting purposes, we've allocated that value over its estimated useful life. It's related to amortization, which goes for different types of assets and things of that nature. It gets a little complex, but these are terms you need to have a basic understanding of. Thanks for watching, and we'd love to hear from you.